macro currency signals.
All right, take a breath. Zoom out with me for a second. Because while everyone is staring at stock indexes and round numbers, something far more interesting is happening in the silver market. Shanghai is paying more for silver than New York. And when two major financial centers disagree on price, that's not noise. That's a signal. When you hear that Shanghai is paying more for silver than New York, your first instinct might be to shrug and say, okay, markets fluctuate. But this isn't random fluctuation. This is a price disagreement between two of the most important financial centers in the world, and markets don't disagree on price without a reason. A premium is not a rounding error. It's not a glitch in the system. It's a message. It's the market whispering that supply, demand, urgency, or trust is not evenly distributed, and when that whisper gets louder, you need to pay attention. Think about how global commodities usually trade. In theory, silver is silver. An ounce in New York should not be meaningfully different from an ounce in Shanghai. Arbitrage traders exist specifically to eliminate price gaps. If silver is cheaper in one place and more expensive in another, professionals normally step in, buy where it's cheap, sell where it's expensive, and close that gap quickly. That's how efficient markets behave. So when a premium persists overseas, especially in a major hub like Shanghai, it tells you something is preventing that clean, frictionless flow. It tells you demand on one side is strong enough or supply constrained enough that buyers are willing to pay extra rather than wait. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. Now here's where it gets interesting. A premium doesn't automatically mean there's a global shortage. It doesn't mean vaults are empty. It doesn't mean the system is collapsing. What it does mean is that regionally, buyers feel urgency, and urgency is psychological before it is physical. If industrial users in Asia believe supply chains could tighten, they don't wait for confirmation. They secure inventory. If investors believe currency risk is rising, they don't debate philosophy. They convert paper into metal. That behavior alone can push local prices above benchmark futures prices in the US. And let's be clear about what benchmark means. The New York futures price is largely driven by paper contracts. It's a financial price discovered through leverage, speculation, hedging, and positioning. Shanghai's higher price reflects what buyers are willing to pay in their own market environment with their own currency concerns, industrial demand, and capital controls. When those two prices separate, you're not just seeing a number. You're seeing two different realities. One reality says liquidity is still abundant and contracts can be rolled forward without much friction. The other reality says metal in hand matters enough to justify paying more. That divergence is the story. Because commodities are supposed to converge, they're supposed to move in sync. When they don't, it means either logistics are tight, confidence is shifting, or regional demand is outpacing supply. And remember, Asia, especially China, is not a marginal player in silver. It's central to manufacturing, solar expansion, electronics production, and infrastructure build-out. If demand there accelerates even modestly, the effect on local pricing can be amplified. Add to that any currency considerations. If confidence in fiat purchasing power wobbles even slightly, then holding physical metal becomes more attractive, not emotionally, strategically. So the premium becomes a thermometer. It measures heat in the system. And right now, the temperature in Shanghai is higher than in New York. That doesn't guarantee fireworks tomorrow. It doesn't mean a delivery crisis is imminent. But it does mean the global silver market is not perfectly balanced, and markets rarely send persistent pricing signals without a reason. When one side of the world consistently pays more for the same ounce of metal, the question isn't, is this noise? The real question is, why are they willing to pay up? Because premiums reflect priority, and priority reveals fear, strategy, or necessity. Sometimes all three at once. That's why this isn't just an interesting footnote, it's a pressure reading, and when pressure builds in one region before another, history shows the rest of the market eventually feels it. Let's slow this down and really unpack the split between paper silver and physical silver, because this is where most people get confused. When you see a silver price on your screen, you're usually looking at a futures price. That price is discovered on exchanges like the COMEX, where contracts representing thousands of ounces trade back and forth all day long. But here's the part that matters. Most of those contracts never result in actual silver changing hands. They are financial instruments. They're vehicles for speculation, hedging, arbitrage, and leverage. They are claims on silver, not silver itself. That distinction sounds small, but it changes everything. A futures contract is essentially a promise. It gives the holder the right to take delivery at a future date. But in practice, the overwhelming majority of traders close or roll those contracts before delivery ever happens. They're trading price exposure, not stacking bars, so the paper market can expand dramatically without a single ounce of metal moving. Open interest can surge, volume can explode, and yet the vaults may barely change. That's because paper silver is elastic. It can stretch. Physical silver is different. Physical silver is finite. It has to be mined, refined, transported, insured, stored. It can't be printed with a keystroke. It can't be leveraged infinitely. If you want a 1,000-ounce bar, someone has to give up a 1,000-ounce bar. That transaction involves friction, cost, and logistics. So when demand for physical rises sharply, the adjustment mechanism is price, and often regional premiums. This is why the separation between paper pricing and physical pricing matters so much. The futures price reflects the balance of traders' positioning. It reflects who is long, who is short, how much leverage is in the system, and what expectations exist about future policy, inflation, and economic growth. But the physical market reflects something more grounded: immediate demand and immediate supply. When those two lanes travel together, the system feels stable. But when they begin to diverge, when physical metal commands a premium over the futures benchmark, that's a signal. It tells you the buyers who actually want metal in hand are behaving differently than the traders who are flipping contracts. And here's the nuance. This divergence doesn't automatically mean manipulation or collapse. It can simply mean that futures markets are heavily financialized, while physical markets are responding to industrial demand, currency hedging, or regional policy shifts. But the divergence itself is the story. Because if physical demand accelerates enough, eventually it puts pressure on the paper market, not necessarily through a dramatic default. More often, it happens through tighter spreads, higher premiums, increased delivery interest, and greater volatility around contract expiration. The system has release valves, margin adjustments, cash settlements, position limits, but those mechanisms activate precisely when stress rises. Think of paper silver like a synthetic layer built on top of real metal. It allows for liquidity and efficiency. It allows companies to hedge production and investors to gain exposure without taking delivery. But it also means the headline price can sometimes move independently of immediate physical demand. That's why you can see futures prices drop sharply even while coin shops report strong buying. The paper market might be deleveraging while the physical market is absorbing inventory quietly. Now connect that to Shanghai paying more. If physical buyers in Asia are willing to pay above the benchmark futures price, that suggests the metal in hand carries more urgency there than the contract on a screen, and urgency is everything in commodities. It's what turns calm markets into volatile ones. The key takeaway here is not to demonize the futures market. It serves a purpose. It provides liquidity and price discovery, but it is not the same thing as physical demand. And when you're trying to understand whether silver is under stress, you can't just watch the chart. You have to ask, is the metal itself being bid differently than the paper version? Because when paper and physical separate even slightly, it tells you confidence, urgency, or logistics are shifting somewhere in the system. And in commodities, those small shifts can matter more than any headline spike on a chart. Let's go deeper into something that sounds technical, but is absolutely critical. Deliverable inventory versus total inventory, because this is where headlines get loud and clarity gets lost. When people look at silver stockpiles on the exchange, they usually see one big number, total ounces sitting in approved vaults. And at first glance, that number can look massive, hundreds of millions of ounces. On the surface, that doesn't scream shortage, it doesn't scream crisis, it looks comfortable. But here's the mistake. Not all of that silver is actually available for delivery. On exchanges like the COMEX, inventory is divided into categories. The two that matter most are eligible and registered. Eligible silver meets the exchange's standards: correct purity, correct bar size, stored in approved vaults. But eligible does not mean it's for sale, it simply means it qualifies. The owner may have zero intention of delivering it against a futures contract. Registered silver is different. Registered is deliverable. It has been specifically designated to meet contract obligations if someone stands for delivery. That is the pool that matters during delivery months. That is the inventory that can actually satisfy demand if traders convert paper contracts into physical claims. Now think about this carefully. The total building might look full, but only a portion of the seats are actually available to the public. The rest are privately owned, reserved, or simply not offered at current prices. So when market participants focus on deliverable inventory, they're not being dramatic. They're looking at the part of the system that can actually move. And here's where the psychology kicks in. If registered inventory starts drifting lower while open contracts remain elevated, tension builds. It doesn't mean there isn't silver in the building. It means fewer ounces are officially available to meet delivery requests without someone changing status from eligible to registered. That conversion can happen. Owners can reclassify metal if incentives justify it. But incentives are driven by price. If premiums rise high enough, if urgency increases enough, metal can move categories. Until then, registered inventory is the active supply. This is why deliverable inventory is not a fuel gauge. It's more like a snapshot of what is actively on the shelf at current conditions. The total supply might be large, but what's available at today's price may be smaller than it appears. Now add volatility to the equation. When markets get jumpy and more traders start talking about delivery windows, that registered number becomes a focal point. Social media amplifies it, headlines dramatize it, and perception starts influencing behavior. Some participants may decide to stand for delivery precisely because they believe others will. That feedback loop can temporarily intensify pressure. But here's the grounded view. Exchanges are not passive. They monitor these ratios constantly. If stress builds, mechanisms exist, margin increases, position limits, cash settlement options. The system is designed with shock absorbers. So, a decline in registered inventory does not automatically mean failure. What it does mean is that the cushion is thinner, and thinner cushions amplify volatility. If a significant percentage of contract holders choose delivery during a window when registered supply is tight, the optics alone can create price spikes. Not because silver disappears, but because supply and demand are negotiating in real time. And remember, eligible inventory sitting in vaults is owned by someone. It is not communal property. If the owner doesn't want to convert it into registered form at current prices, it won't move. Price is the lever that unlocks it. So when you hear that deliverable inventory is hovering near certain levels, don't jump to extremes. Don't shout shortage, but don't ignore it either, because the portion of inventory that is actually for sale under contract terms is the part that determines short-term stress. Total inventory tells you how big the warehouse is. Registered inventory tells you how much is sitting at the checkout counter. And when Shanghai is paying a premium overseas while registered stocks drift lower domestically, the market is quietly asking a question: will price need to rise to coax more metal into the deliverable category? That's not drama. That's supply mechanics. And in commodity markets, mechanics matter far more than headlines. Now let's talk about margin hikes and volatility, because when these two show up together, the market is telling you something is getting rowdy under the surface. Most people see a sharp drop in silver and assume demand vanished, or they see a vertical spike and assume a shortage just exploded. But often, neither is true. What's actually happening is leverage is being squeezed out of the system. Here's how it works. Futures markets run on margin. That means traders don't put up the full value of the contract. They post collateral, a fraction of the total, to control a much larger position. That's what creates liquidity. It's what allows participants to hedge or speculate efficiently. But leverage is a double-edged sword. It amplifies gains and it amplifies losses. When volatility increases sharply, exchanges step in and raise margin requirements. They do this to protect the clearing system. If prices are swinging wildly, the risk that someone can't cover losses rises. So the exchange demands more collateral from everyone holding positions. Now think about the chain reaction that creates. If you're heavily leveraged and margins jump overnight, you have two choices: post more capital or reduce your position. Not everyone has extra cash sitting around, so some traders are forced to sell. That selling can push price down quickly. And that drop has nothing to do with fundamentals. It has everything to do with risk control mechanics. This is why you sometimes see silver fall hard right after a major rally. It's not necessarily that demand disappeared, it's that leverage expanded during the rally, volatility followed, margins were raised, and weaker hands had to exit. It's a cleansing process, painful, fast, and mechanical. But here's the twist. Margin hikes can also intensify upward moves. If volatility explodes because price is ripping higher, short sellers feel pressure. If they're leveraged and price keeps climbing, they may be forced to cover. That buying can create a feedback loop. Price rises, pressure increases, shorts cover, price rises again. It can look like a squeeze even if the underlying supply hasn't changed. So when you see the exchange raising margins in precious metals, don't read it as a bearish or bullish signal by itself. Read it as confirmation that volatility has reached a level that threatens stability. It's the referee stepping in because the game is getting aggressive. And right now, silver has been behaving like an emotional asset. It doesn't drift. It lunges, it spikes, it slaps back, it snaps higher again. That kind of behavior forces exchanges to adjust requirements more frequently, and every adjustment shakes out a different group of participants. Retail traders feel it, hedge funds feel it, industrial hedgers feel it, liquidity thins temporarily, spreads widen, and headlines multiply. What makes silver especially sensitive is its hybrid nature. It's not just a monetary hedge like gold, it's also an industrial input. That means two completely different investor bases are active at the same time. Growth optimism can drive it. Inflation fear can drive it. Currency weakness can drive it. Solar demand can drive it. When multiple narratives collide, volatility rises naturally. Now layer on top of that increased retail participation. When smaller traders enter through mini or micro contracts, they often use higher leverage relative to capital. That can amplify swings, because retail positioning tends to be more emotional and less capitalized than institutional hedging. So margin hikes in this environment are not random. They are responses to a market that is swinging harder than usual. And here's the key takeaway. Sharp price drops after margin increases do not automatically invalidate the broader thesis behind rising premiums or strong physical demand. They often represent forced liquidation, not a collapse in interest. Conversely, sharp spikes do not automatically confirm structural shortage. They can represent short-covering cascades amplified by leverage. Margins are the system's shock absorbers. When they get adjusted repeatedly, it means the ride is getting bumpy. And when the ride gets bumpy, in a market where physical premiums are rising overseas, deliverable inventory is being scrutinized, and volatility is accelerating, that tells you silver is no longer trading like a sleepy commodity. It's trading like a contested asset. And contested assets don't move smoothly, they lurch. Now let's zero in on China's role in this equation, because you can't understand why Shanghai might be paying more for silver unless you understand how central China is to the global silver ecosystem. This isn't a side character in the story. China is one of the main engines. Silver is not just a monetary metal sitting in vaults. It's an industrial workhorse. It's embedded in solar panels, semiconductors, electric vehicles, 5G infrastructure, medical devices, and advanced electronics. And China sits at the heart of much of that manufacturing capacity. When global electrification accelerates, when renewable build-out expands, when export production ramps, silver demand flows through Asia at scale. So when you see a premium in Shanghai, you're not just seeing investor speculation. You may be seeing manufacturers competing for supply. Industrial users don't think in meme cycles. They think in procurement cycles. If they anticipate tightness, they secure input material early. They lock it in. They don't gamble on spot prices being cheaper next month if production schedules are on the line. That kind of demand is different from speculative demand. It's steady, and it can be aggressive when necessary. Now add another layer: currency dynamics. China operates within a different financial architecture than the United States. Capital flows are more managed. Currency risk is viewed differently. Domestic investors and institutions often have fewer avenues for capital preservation compared to Western markets. Precious metals can serve as a hedge not just against inflation, but against policy uncertainty and capital controls. If confidence wobbles, even slightly, domestic demand for physical metal can rise quickly. Not as panic, but as precaution. And here's where it gets even more interesting. When Chinese exchanges tighten trading rules or raise margins on metals, that's not casual. Exchanges don't intervene unless participation becomes intense enough to warrant cooling measures. Increased margin requirements signal elevated volatility and heightened speculation. It means the crowd is active. But tightening rules doesn't eliminate demand. It just reshapes how that demand expresses itself. Some traders reduce leverage, some shift to physical, some step back. But the underlying interest doesn't just evaporate. So when Shanghai trades at a premium, you have to ask, is this industrial pull, investor hedging, or both? Because if it's both, that creates a powerful base layer of demand. Now zoom out to the strategic level. China has been steadily positioning itself in critical mineral supply chains for years. From rare earths to battery metals to solar inputs, long-term industrial dominance requires secure access to raw materials. Silver plays a role in that infrastructure. While it may not be stockpiled in the same way as gold, consistent accumulation and strong domestic pricing signal that it holds strategic value. And strategic value changes behavior. Markets don't just move on charts. They move on policy direction, industrial planning, and geopolitical positioning. If Chinese buyers perceive future supply constraints, whether due to mining disruptions, trade tensions, or currency risk, paying a premium today can be rational. From their perspective, securing metal now may be cheaper than scrambling later. That's why this isn't just a speculative divergence story. It's a structural one. Industrial demand growth in solar alone has been substantial over the past decade. Electrification themes are not short-term narratives. They're multi-year transformations. Even if growth slows temporarily, the baseline demand remains higher than it was years ago. And when a country that dominates global manufacturing pays above benchmark pricing for a key industrial input, that deserves attention. It doesn't mean crisis. It doesn't mean shortage. But it does mean the center of gravity in demand might be shifting. If Western markets treat silver primarily as a trade, while Eastern markets treat it as both industrial necessity and monetary hedge, then pricing tensions can emerge naturally. So Shanghai's premium isn't random. It reflects regional priorities, industrial pull, and financial positioning. And when the world's largest manufacturing engine is willing to pay more for an ounce of silver, that's not noise. That's signal. Now we arrive at the most important question of all. Is this temporary or is it structural? Because markets can get loud in the short term. Premiums can spike for a few weeks, volatility can explode and then fade, delivery numbers can look dramatic and then normalize. So the real work is not reacting to one data point. The real work is determining whether we're seeing a passing imbalance or the early stages of something more durable. Let's start with the temporary case. Premiums can widen simply because of logistics, shipping delays, refining bottlenecks, short-term inventory mismatches between regions. If physical demand surges in Asia for even a brief period, perhaps due to a procurement wave or a burst of investor buying, local prices can lift above global benchmarks. Arbitrage eventually steps in. Metal flows, the gap narrows, volatility cools, the system rebalances. That's normal market behavior. The same applies to deliverable inventory. A dip in registered stocks can occur because holders choose not to designate their metal for delivery at current prices. If price rises enough, incentives shift, metal moves into registered status, and tension eases. Futures markets are built with flexibility for this reason. They anticipate imbalance and allow price to function as the release valve. Margin hikes also fall into this temporary category. When volatility spikes, exchanges tighten conditions. Leverage gets flushed, weak hands exit, the market resets. What looks like structural stress may simply be the mechanics of a leveraged system shaking itself out. So yes, there is a scenario where everything we're seeing is a short-term storm. But here's the structural side. If overseas premiums remain elevated for an extended period, that suggests more than logistics. It suggests persistent demand pressure relative to supply. If deliverable inventory trends lower month after month while physical deliveries remain strong, that points towards sustained appetite for metal rather than episodic interest. If industrial demand continues climbing due to electrification, renewable expansion, and technological growth, and mining supply doesn't accelerate at the same pace, then tightness becomes more embedded. And if currency confidence subtly erodes over time, precious metals don't need panic to rise. They just need steady hedging behavior. Quiet accumulation can be more powerful than dramatic buying frenzies. Structural change doesn't announce itself with fireworks. It reveals itself in persistence. That's the key word. One premium spike is noise. 6 months of consistent premiums is information. One volatile delivery window is mechanics. Repeated aggressive delivery months begin to look like preference. One margin hike is routine. Repeated tightening cycles reflect sustained turbulence. The market doesn't break all at once. It stretches first. And structural stress rarely shows up as an obvious failure. It shows up as friction. Higher premiums, faster inventory turnover, increased delivery interest, more frequent rule adjustments, slightly elevated volatility that never quite returns to calm. The difference between temporary and structural comes down to duration and behavior. Does demand fade when price cools, or does it return on every dip? Do inventory levels recover quickly, or do they stabilize at lower ranges? Do premiums compress naturally, or do they reappear with each wave of buying? Those patterns tell the story. And here's the balanced truth. It may not be purely one or the other. Markets often transition gradually. A temporary spike can expose a deeper imbalance. A regional premium can reveal a longer-term shift in demand geography. A volatile delivery window can highlight how financialized pricing interacts with physical reality. What matters most is observation without emotion. Not assuming collapse, not dismissing signals. Watching whether incentives continue to shift in favor of holding physical over paper. Watching whether supply responds fast enough to meet rising industrial and investment demand. Watching whether pricing gaps close smoothly or reopen repeatedly. Because if this is structural, the moves won't just be sharp, they'll be persistent. And persistence is what transforms volatility into trend. So the question isn't whether silver will spike tomorrow. The question is whether the underlying forces, industrial demand, currency hedging, inventory dynamics, and regional premiums, keep reinforcing each other over time. If they do, that's not temporary noise. That's the market quietly repricing reality.